All right, welcome back to another edition of Financial Accounting. We're going to jump into one of the objectives 1.1 and 1.2 for Chapter 1. So let's begin with that. We're going to talk about a little bit an overview about financial accounting, what you're expected to know in this class. A lot of the material is conceptual in nature and definitional in nature. You may be compelled to memorize that. That's fine. There's not a whole lot of calculations or technical recording of transactions for the first exam. So just be aware of that as we go into these various topics. Learning objective 1.1, we talk about why accounting matters. Why is it critical to businesses? Well, it's a system. Overall, accounting is an information system. So we are concerned about making sure that the business has the right information to make the right decisions. Accounting helps us with that, helps decision makers make those decisions by measuring all the business activities, primarily transactions that are financial in nature, processing the data into financial statements and reports so that information can be easily digested and used, and communicating those results to the decision makers. Those can be people like the CEO, the chief executive officer, but it can also be things like the stockholders themselves. Whoever needs or wants to use this information, that's what we're interested in knowing about. That's what we're interested. Those are the people we're interested in pleasing to give them the right information that they need. Accounting is known as the language of business. That's one of the reasons why it's so critical, because all businesses use accounting or they need accounting. Therefore, it is a language like French, German, and Spanish. You just have to learn it by practicing it over time because it's the language that helps take all that complex information and simplify it into those digestible chunks. So that's why I give you lots of practice in this class. Accounting information is used to produce those financial statements. Like I said, that's the output. That's the main output that users need, not the whole detailed aspects of the business, just a summarized overview of what went on and where the company stands. Financial statements report information about the business itself, what has happened to the business. There may be information included about employees or certain executive officers, but the number one thing to realize is it's going to be information about the business itself and what goes on. Mind you, there is some information that's not included in the financial statements, but generally that has to do with things that are not very relevant or material. Who uses financial statements? Everybody. Nonprofit organizations use it, governmental organizations, for profits. Everybody uses that stuff in across all the spectrum of all different industries and sectors. So that's why it's so broadly applicable. That's why it's so critical, is for everybody to use that stuff. Accounting's mechanical process is known as bookkeeping. Bookkeeping is the recording of journal entries, debit this, credit that, post to the T account, create a trial balance. All that stuff is covered in Chapter 3. This class goes into much more detail. So you have to kind of buckle up because it's going to be a pretty quick ride. Documenting and recording is what bookkeeping is known for. Taking certain information from receipts and invoices, putting it into the ledger, making financial statements reflect what has actually occurred in the business from those source documents. But keep in mind that the process of doing accounting begins and ends with people who make decisions. We don't go through and record things willy-nilly. We have specific people who tell us to do specific things. It's their authorization that gives us permission to conduct transactions and record that information. If you were to ask me what is accounting in general, I wouldn't be able to really describe it. Accounting involves a lot of different things. Financial accounting tends to be the biggest part of accounting in general. But if you think about accounting overall, there's financial, there's managerial. We see down below there. But accounting also involves audit, tax, and other types of consulting or legal services. Forensic accounting can be one of those legal services that we're hired to do, but financial accounting takes up the bulk of what accounting really is, which is what this class is all about. What is the purpose of financial accounting? Financial accounting tracks business activities and transactions of a business. A business is comprised of events and transactions. We identify that, we record it, and we report it because those people who are mostly interested in that information tend to be stockholders or creditors, which can include banks. Banks are a form of creditor. The primary objective is to make sure that information is useful, not just useful in terms of, oh, it matters. It's useful in terms of, oh, it's also given out in a timely fashion. Information that's not useful, things that don't really matter too much, we don't record that or disclose that. There's lots of things that could affect a company, but potentially is not worth reporting to investors because generally speaking, they won't act on that information. Disclosure is highly regulated. So in financial accounting, we worry about meeting the regulatory standards as set by the Financial Accounting Standards Board, the FASB. They're the ones who create the rules. We have to abide by those rules. The Securities and Exchange Commission checks to see that we are abiding by those rules set up by these guys, the FASB. Managerial accounting tends to be a little bit looser, but realize that managerial accountants use information from financial accounting systems. So accurate financial accounting information results in more accurate managerial accounting information and output. Otherwise, garbage in, garbage out. But what types of things do managerial accountants tend to produce? Budgets, forecasts, any type of spreadsheet or report that is not necessarily regulated. It's just being requested by a manager. But keep in mind, but generally speaking, managerial accounting is all about producing information that's going to be used internally. It's not going to be sent out to investors or creditors. If we're talking about the business form, and how accounting is useful to all these businesses, we might as well try to figure out, hey, look, what are the different types of businesses that could potentially use financial accounting information? Well, it starts as simple as a proprietorship and gets more complicated up to the corporate level. The key distinction among these categories, and we'll talk about them in a second here, is really this line that distinguishes partnerships and proprietorships from LLCs and corporations. What is that distinguishing feature? It's called limited liability protection. Limited liability protects investors from losing more than just the amount that they've invested. They potentially have cars and houses, they're pretty well off. They take $100,000, they put it into a business. If that business goes belly up or bankrupt, the investor is only out for that $100,000. Limited liability protects the assets, the personal assets of the investors. The IRS is not going to be able to go after the corporate stockholder's car or house. We want that limited liability protection because we believe that investing in a company is risky enough as is. We don't need to put our personal assets on the line. So corporations and LLCs tend to take the preference in that case. Corporation being the biggest form, the more complicated one. That's the one that shareholders like the most because, hey, if you're going to attract shareholders, you might as well indemnify them from being sued if the company goes into bankruptcy. Banks and creditors tend to hate the corporate form. Hate is a strong word, but the reason why is because banks want to get, if a company goes belly up, a bank wants to go after anybody who can replenish or provide any full recourse for the amounts that the bank lost from lending money out. So banks don't like the fact that they have to stop at the corporation, that they can't go off to the stockholders and get their money back. So limited liability protection is a very key aspect of owning a business. If you start a business, generally you want to file paperwork, but even if you don't, but you start conducting like a business, you're considered essentially a proprietorship by default. Proprietorship by default is essentially a single owner. Some people call them mom and pop shops. That's possible. But those are the ones that have the maximum control. I'm going to be a business owner. I'm going to be my own boss. Your proprietorship, right? That's fine, but here's the thing. You need to be careful about the legality of doing such a thing. Because if you're a proprietorship and somebody has a slip and fall outside of your store, that person who fell down can sue the company, the proprietorship, and sue you for your house in your car. That sort of legal liability is not a good thing. So the company is not separate from the owner in the proprietorship. You are the owner. You are the owner of the business. Therefore, you are the business. You personally can be sued. From a tax perspective, keep in mind that everyone's going to pay taxes, but doing taxes for your business as a proprietorship is pretty easy because you just fill out the profits essentially on your own personal tax form. You don't need a separate tax form or file separately a tax return for your company. It's all just done on your personal tax form. So you're only taxed once. It's all kind of contained within your financial statements to the IRS. A partnership is like a multiple proprietorship. You're going to have more than one person as the owner in this case. They tend to be smaller, medium-sized companies. Sometimes they're referred to as firms because they're a firm of multiple people who all have, say, a portion. Hey, I'm a 10% owner, you're a 10% owner, whatever. We share the risk across the board. We don't, it's not all placed on us, the burden. So we all have to put in our fair share of work to make the company profitable. The good news about being a partnership is it's only taxed once. So if you're a 10% partnership holder and the company earns a profit, you are going to report 10% of those profits on your personal tax return. Pretty simple, pretty straightforward. You don't have to have the partnership file its own financial statements. From a legal standpoint, it's still risky like the proprietorship because you as a partner are not considered separate from the partnership. So you want to consider very heavily whether or not you want that burden. Another thing you have to realize about partnership is you may be a 10% owner, but if the other 9 owners, you have the other 90% owners, all of a sudden go missing as soon as the IRS tries to seize the assets, you as a 10% owner might be liable for 100% of the debts if you're the only person who's available to pay off any judgment claims against the partnership, i.e. you. So you got to be very careful. It's possible you can protect yourself as a partner by setting up an LLP. Those are available in some circumstances. LLPs tend to provide partners with limited liability protection, much like the LLC. The LLC, the limited liability company or limited liability corporation, different states use different terminology. The LLC tends to be the sweet spot for a lot of business owners, especially small business owners, because it does 2 things. It protects the personal assets. It protects the personal assets of the owners from being seized in a judgment claim in a court system or by the IRS. So it provides some sort of veil, a wall in between the company and the owners. So people, if there's a slip and fall outside the store, only the company can be sued, not the owners. In the terms of taxes, it's also beneficial because it's only taxed once. So it's like proprietorship and partnership. The LLC makes a profit. You put in your portion of that profit on your tax return. You file your tax return, call it good. Other thing to keep in mind too is if you're an LLC, you don't have to have more than one owner. You can be the sole owner of an LLC. You're not considered a partner or proprietor. You're considered what's called a member. You should have 100% membership, or you can spread it out and say, hey, I want to be a 51% member holder and give out the other 49 or issue the other 49 to other investors. Either way, you get the benefit of both worlds. Taxed once, limited liability protection. That also extends to corporations, except that corporations are taxed twice. When a corporation makes a profit, those profits are taxed at the corporate level. So imagine that corporation earns $100,000, pays out $20,000 in tax. Yikes, $80,000 is left over. That goes into retained earnings. That's considered net income. Corporations can decide if they want to distribute those profits to the stockholders as a reward in the form of what's called a dividend. If that 80,000 is given out distributed to stockholders, that 80,000 appears on those individual stockholders' tax return. It's probably going to be taxed. It's definitely going to be taxed if they receive dividends. So you're looking at roughly about 60% of a pre-tax profit from 100. 60% of that is actually ending up in the actual pockets of the owners. Whereas you'd only be taxed once if you're an LLC. An LLC, you pay your fair share and that's it. So that's the downside of it being a corporation, is double taxation. That's if the money is distributed to the stockholders, but you still get that limited liability protection. That's a good thing. talked a little bit about the tax and legal implications of having different forms, different business forms, but it needs to be clear that regardless of whatever form you take, corporation or partnership, when you start a business, you need to consider yourself, your financial accounting records, personal records, separate from the business. One of the best ways to do that is to set up a separate checking account for that business. You want to keep separate records, if anything, to indicate to the public, look, this is something that has its own purpose, it has its own mission, it is separate from me. I don't use that cash to pay my bills. I don't use my cash to pay its bills. It's separate. You want to keep those things separate and distinct. If anything, it makes it so much easier down the road as the business becomes bigger and bigger and becomes more complicated. We don't want to intermingle assets between the company and ourselves. So it's important from a financial accounting perspective to look at the business as separate from the owner, have separate accounting records. From a tax perspective, as you saw, a clear, a pretty clear distinction between partnerships, LLCs, and corporations is this notion of legal liability. If a company is not viewed as separate from the owners, generally it's going to be taxed once. You're the business is you, you're one thing, tax you once. If you're a corporation, if you invest in a corporation, the corporation is a thing, you are a thing, corporation gets taxed, then you get taxed. That's double taxation. The sweet spot is to have limited liability protection and being able to be taxed once, which is why LLCs kick ass. Double taxation, again, what does that mean? You got to look at this corporate form as its own living entity. Just like us, a corporation pays tax. It files its own tax return just like you and I do. If a corporation then pays money out from those profits after tax, the owners are then taxed. So that's the 2-for-1 right there. Who makes the rules that we follow? There are different rules, of course. When we think about rules, broadly speaking, we mean we have to follow certain instructions. What we just talked about in the previous slides were laws. Laws are set by legislative bodies like our Congress at the federal level. Our Congress sets tax laws. We have to follow those. Congress sets other types of statutory laws. When it comes to the rules that we follow, who sets those rules and are those considered law? Technically, they are considered law. The rules in the United States that we must follow are set by the Financial Accounting Standards Board. Those rules are called Generally Accepted Accounting Principles, GAAP. They set the rules, we have to follow them. From an international perspective, outside of the US, you still follow GAAP? No, outside the US, generally you follow different sets of rules called IFRS, International Financial Reporting Standards. That's set by the IASB, International Accounting Standards Board. This class is focused on the FASB and GAAP. We don't have time to go into IFRS, that's a whole other subject, but keep in mind that the FASB sets GAAP, the rules, the laws, and the SEC monitors or polices whether or not companies are following those rules. If GAAP is followed correctly, there's no problems. If GAAP is not being followed correctly, the SEC can issue fines or sanctions. And essentially, when you think about the SEC, Securities and Exchange Commission, is a U.S. regulatory body. Congress created a statute that created the SEC. The SEC has power from the U.S. federal government to create regulations. One of those regulations says, hey, all companies must follow GAAP. If a company does not follow GAAP, does it break the law? It doesn't break statutory law. It breaks what's called administrative law. It has the same bite, but essentially when you think about the law created the SEC. SEC is creating new laws called administrative laws. So we want to follow all kinds of laws, including administrative laws, follow GAAP. Before we even get into the different types of rules, we need to have an understanding of some underlying assumptions and principles. One of them is the entity assumption, which is what we just talked about before. You, from a financial accounting perspective, are separate from the business. The business, from a financial accounting perspective, is its own living being. From a legal and tax perspective, that may not be the case. But from an accounting perspective, we always view the business as its own economic unit. The continuity or going concern assumption, what is that? It means that for corporations in particular, a corporation will live forever, forever. LLCs, not so much. Corporations are viewed as living entities that live forever. That being the case, should stockholders die or pass away for whatever reason, even if all of them spontaneously combust and die, the corporation will still go on. It will still exist. It will still conduct business. We need to find out who the new shareholders are, but the business doesn't die because the stockholders die. Stockholders pass away, business still goes on and on and on. Stable monetary unit assumption is a big phrase for basically saying we ignore inflationary effects. Why do we ignore inflationary effects? It becomes too complicated. We lose predictability and consistency in our financial reporting. If we every year we have to update our numbers based off of, hey, how much we bought this thing a year ago or 50 years ago, how much is this thing worth in today's dollars, right? Back in my day, a candy bar was a nickel. That's great. Today it's like buck 25. We do not adjust our assets for inflationary effects. We say if we bought that candy bar for a nickel back in the day, it's still on our financial statements as a nickel. It wouldn't be something we would want to eat. It's probably way past its expiration. But the bottom line is this: you buy something, it goes into our financial accounting system at that cost, and we leave it alone. We don't adjust it for inflation. That is another way of saying that we adhere to what's called an historical cost principle. What we pay for something is the actual cost we pay for something becomes the value in our financial statements. Why? Because that information is reliable. We have a receipt. We see that the money has actually left our checking account. That becomes the evidence for what this value is fundamentally. Is there a fair value for certain assets? Of course there are. There are lots of different fair values that we can pull down and utilize if we wanted to adjust to fair value, but it's too much of a headache. It's cost prohibitive to do a fair value evaluation of all of our assets. Primarily, we only use fair value for investments, stocks that we buy in other companies. Corporations can buy stocks in other corporations. Those investments can be marked to market, brought up to fair value or down to fair value, but everything else we just leave at historical cost. You bought land $50,000 50 years ago. Maybe it's worth $1 million today. It still shows up as $50,000 in their books. It helps, I think, to sort of look at accounting principles and assumptions from an example perspective. So what I want to do here is talk about the historical cost principle. Let's say in January 2020, we paid cash $50,000 for a car. At that time, Kelley Blue Book's value for that car was $60,000. The dealer's cost basis, what it paid for was $45,000. Another dealer has that same car for $55,000. Why do we care? The only amount that we care about is the $50,000. The other information is just noise. The value to us is what we agree we're willing to pay and what the seller is agreeing to sell it for. So the price we pay, that becomes the value. That sticks in our accounting system at that cost. Everything else is just noise. Take that example into the stable monetary unit assumption example. Let's say 35, 36 years later, when you think about 3% inflation, should that car, that $50,000 car, be worth more? Because inflation of 3%, hey, it may cost us $115,000 today to buy that same car. We don't worry about that. The car will still show up 35, 36 years later at $50,000 because why? We do not adjust for inflation. Ignore inflationary effects. The entity assumption. The owner is separate from the business. So Beerbo Inc. is a company that distributes and produces beverages. Mr. Swaggins is the founder, majority shareholder, and CEO. Mr. Swaggins has some personal assets, maybe some jewelry, and holds those pieces of jewelry in Beerbo's safe. Well, if those assets are now on the property of Beerbo Inc. and in Beerbo's safe, does that make the jewels now part of Beerbo's assets? No, it doesn't. Beerbo does not record Swaggins' personal assets along with its own. The business, you may go to a business's site and you may see a bunch of equipment, but that doesn't necessarily mean that the business owns that equipment. We can make that assumption. That equipment's there, the business owns it, not the owners, the business owns it. But there's only one way to determine that is by proof of an invoice or some type of documentation. So the reality is we want to make sure that regardless of how much the owners own and where that those assets are, the business has its own assets and it will report just what it owns separately. The continuity or going concern assumption. This one's a little bit complicated, but you have to think about it like this. We know that corporations will live forever, but what if we find out news that, hey, the company is going to go bankrupt within a year, say 6 months? Okay. Assume we have a patent that goes 5 years, has 5 years of value. We expect, and maybe the value left on that is like $10,000 on our books. We plan to get value from that legal protection of $10,000. $10,000 worth of legal protection. Nobody is going to copy us, right? Or try to do or compete with us on this patented protected product. But that $10,000 worth of value is value we expect to realize over 5 years. If we find out that the business is going to go kaput in 6 months, will we realize that $10,000 of value? Probably not. We may have to write off $9,500 of value potentially, or maybe more, or maybe we just write off the whole thing because we're not going to enjoy 5 full years. We'll barely enjoy 1 year's worth of value from this patent protection. So in the case of a going concern, we don't think, when we look at $10,000 on the balance sheet, we don't think, oh, they're probably not going to get that benefit. We make an assumption that the company will get $10,000 worth of value because there it is, $10,000. If the company is going to go bankrupt in 6 months, they need to adjust that number down because that patent becomes worthless if the company goes bankrupt. What makes accounting information useful? Well, first we have to figure out who's going to be the user of financial information. The users are going to be investors, lenders, and other people who potentially make some type of investment decision. Not all information needs to be reported, just information that's useful in particular to these people. Anybody and everybody can use financial statements, but we have to be very specific about who our target audience is and what their needs are. Generally speaking, this makes sense. A user's needs for information is information that's both relevant and trustworthy. There are other enhancing qualities of what information is. We'll talk about those in a second. But more importantly, costs must be easily acquired and must be easily disseminated, at least from when I say easy, cost effective. Some information is too difficult to acquire and it may not be practical to disseminate. So there's a cost restriction. We can't show all information about the company. We have to summarize it and scrutinize over what type of information to give. But these are the things, these are the factors, these are all the ingredients that helps the FASB determine what the accounting rules are. What makes accounting information useful? The fundamental qualities, relevance, and faithful representation. What I like to call R, F, and R, baby. Relevance, meaning it matters. It's material in nature. It has the capability of changing a decision or having investors make a decision or confirm an investment decision. If it's not relevant, it doesn't matter. We ignore it. It also has to be trustworthy, faithful representation. It's a fancy phrase for saying, can I rely on this information? It can be relevant information. A lot of tweets you might see from, say, political people, political representatives, might be very relevant, but probably not very trustworthy. Certain claims made that aren't going to happen. For instance, how do you take information? Let's assume information is both relevant and trustworthy. How can you make that information better? By VUCT. Make the information better by making it verifiable, understandable, comparable, and timely. Verifiable. How do you make trustworthy information more trustworthy? You back it up with supporting evidence. Here's an invoice. Here's a check stub. That takes trustworthy information up to a higher level. It augments its usefulness. It's understandable. It's not a bunch of gibberish. I have a reasonable knowledge about what goes on in that industry. Within reason, I can understand what's going on. It's written in clear English, for instance. It's comparable to similar companies. If I invest in Tesla, it may not be comparable to Ford necessarily, but at least they're using the same language to report the information. In other words, it's not going to be apples and oranges. If I want to compare Apple versus Microsoft, they're going to have very similar items on their financial statements to allow me to make a decision. Do I want to invest in Apple or Microsoft? In other words, the information is comparable. If it wasn't comparable, they're using different rules, for instance, and different formats of financial reporting, or maybe no financial reporting at all. We're talking about apples and oranges. We can't make a comparison. We can't make an investment decision. So comparability is key. Timely. Hey, information was back in 2018, there was certain information that was very relevant. But if that information never got disseminated, never got published, nobody knew about it, it doesn't really make it useful. You tell me information from 2018 that was relevant back then, I'm not going to think it's very useful. But if you tell me information as of today, that happened today, oh, that's very relevant. That's very useful. So the idea about information being useful is that it's got to be given out in a timely fashion. Otherwise, it gets stale and pointless. One thing you just want to be careful about is not confusing fundamental qualities with enhancing qualities. Fundamental qualities, relevance, RF&R, relevance and faithful representation, that's at a minimum. This is how you get in the door. Whether or not you actually get a dance partner depends on VUCT, whether things are verifiable, understandable, comparable, and timely. Those are enhancing qualities. That does it for Learning Objectives 1.1 and 1.2. Make sure you jump in and do the homework and get this stuff done as soon as possible.